Thanks, Simon. Thanks for having me. Today, as I guess the title of the presentation gave you the idea, we're going to look at how to build diversified portfolios with using ETFs. And I think the idea of a diversified portfolio or balanced portfolio is always very important. But in times like these, where we see a lot of market turmoil, I think people always question their decision around a portfolio. And that is not only if it's a long-term portfolio, but even if it's a goal-based portfolio for next year or the year after, or in 5 years' time. So I think this topic is one that is important, and I guess it gets accentuated in times like these. So if we look at what we're going to be running through today, we're just going to touch back on what is a balanced portfolio. Then we're going to look at asset allocation, and from our perspective, we think asset allocation is key in constructing a long-term portfolio. Then we're going to look at why ETFs are actually great building blocks to construct a balanced portfolio. And then we're going to be touching on a couple of examples. We're going to look at a growth balanced portfolio, or what you would see in the market normally as a high equity balanced portfolio. And then we're going to look at something that's defensive or slightly more conservative. And then lastly, I'll show you the full One Invest fund range for you to get an idea of what is available to plug different needs within your portfolio that you have constructed. As Simon said, I'm going to keep the presentation to 25 to 30 minutes, and hopefully we can have a nice interactive dialogue after the presentation. So let's look at, just quickly looking at what is a balanced portfolio. So if we look at the strategy, there's basically balancing risk and reward. And reward can be seen as return when it comes to the investment side. And on the one end, you've got a very strong conservative capital preservation need, and on the other side, you've got a need for your portfolio to grow, because you actually need to reach your goal and you need to outperform inflation, otherwise you're just standing still. So it's this balancing act between not wanting to lose money, but having to make your funds grow in order to achieve a certain goal. As I said, the goal of a balanced portfolio is multiple folds for different clients. Some people want income out of the portfolio. So if you're in retirement, you want income out of the portfolio because you actually need to live from the income. And on the other side, if you're younger and you've got a longer time horizon to your goal or to your desired outcome, you need your capital to grow. If we think of the most basic balanced portfolio, it normally consists of equities and bonds. And equities in the market is normally seen as the growth asset, and bonds is seen as more the conservative asset that yields an income. And the way I like to think about these two and how they interact, and sometimes it gets turned around, but basically you're looking at equities playing the offensive role, i.e. going forward, growing, scoring a goal, and bonds being your defensive play. So it's more steady, it's got less volatility, you've got less risk of actually losing your capital. But as we know, in times like these, what we've seen with the South African bonds is we had a downgrade from Moody's, we had the impact of COVID, we have political uncertainty, we've got higher unemployment, all of that starts playing in on the bond market, and we've seen the bond market actually blow out quite a bit over the last 3 months. So yes, you can attach a tag to something like defensive or slightly more conservative, but in markets like these, most asset classes become volatile, and the importance is how do you actually use the combination of them to create a steadier ride through the storm. And then lastly, it's always important to not look at somebody else's balanced portfolio, but look at your own needs first and then construct the portfolio. Because I think everybody's risk appetite and risk objectives are slightly different, and hence you need to have a slightly different approach to how you construct a portfolio. So that is what is a balanced portfolio. Then we're going to get into asset allocation, and why do we say asset allocation is key? And there's multiple studies that have been done over a number of years, and also a lot of market commentary that consistently underlines the importance of asset allocation. but this is probably the most well-cited study in the world around asset allocation and why long-term asset allocation is actually key. This was done in the early 90s, and the study looked at a number of portfolios, and it looked at what was the biggest contribution or contributor to portfolio returns. And as you can see, 91.5% of the return of the portfolios that were assessed, the return was actually driven by the asset allocation. Only 5% was driven by security selection. So that would be, do I buy Stanlib over First Rand, or do I buy MTN over Vodacom? So that's the stock selection. Market timing was only 2%. So market timing is, when should I be in bonds? When should I be in equity? Should I be overweight property? Should I put my money into cash? That's market timing. And then other factors, only 2%. So this tells you that if you get your asset allocation right, it's going to drive the majority of your long-term return. So let's flip that around and put it in language that relates to us as investors. So if we have a long-term goal, either retirement, buying a holiday home, sending our kids to varsity, the most important thing for us to reach our goals would be to get the asset allocation right. So that's why it's key for us. What we're going to do now is just quickly look at the different asset classes that you would normally find in a balanced portfolio or balanced fund. We've got equities. As we said, equities consist of listed shares. So we said earlier, Standard Bank, First Rand, MTN, Anglo, Billiton. So those would be the normal equity or shares that you would buy on your online share trading platform like OST. But normally you would think of the payoff period of shares as slightly longer term. And if you look at various fact sheets of equity type products, you would say, people normally say it's suitable for a longer than 5-year time horizon. Bonds provide you a steady income stream, and they normally either issued by the government, so South African government issuing bonds, or you can get corporate bonds, so that would be a company issuing bonds into the market because they want to raise some capital to do expansion or growth from. The third one is property. So in South Africa, we've got quite a large property sector, so listed property sector. And as we all know, you've been following the news, property as an asset class have been under some pressure the last 12 to 18 months. And I think the onset of COVID and the uncertainty post COVID has created more pressure on the property sector. And then lastly, we sit with cash. As we know, there's a lot of terms in the market. People say cash is king. If you've got cash, you've got options. And that's basically in a balanced portfolio to either protect your capital or give you the flexibility to use some money in the future if you need income out of your fund. In a more complex asset allocation strategy, you would look at other asset classes. So you would start looking at things like commodities, and I'll show you our commodity ETFs in a bit. You might look at something like alternative asset classes. In a personal portfolio, you would start considering your house, for instance, as an asset. If it's paid down, it should form part of your view. So there are other things to consider, but if you go into the most simplistic way to view a balance, these would be the 4 asset classes you look at. This slide looks quite simplistic, but I think it's an important concept to land. If you look at the top, the heading says a relationship between risk and return. And investment, the notion normally exists that if you are willing to take more risk, you should be rewarded with higher return. But that reward with higher return is you have the potential to earn a higher return, and you can see potential is there in the table itself. So if we go from bottom left, which is the lowest risk but lowest possibility of return, and we go top right, you probably think about cash as being bottom left, and then up the chart you would think about bonds, and up from there you think about property, and top right corner you would think about equity. So if you think about the risk and return spectrum, you would plot the asset classes on that line. For me, this is a very important slide to maybe just stand still for a while, and that's thinking about asset allocation or constructing your portfolio from a bottom-up perspective or from a top-down perspective. And if we look at bottom up first, and that's normally, I think, an error that a lot of us make as retail investors. We think about, firstly, what fund manager I like, or do I like the top 40 of bonds? And then you only say, do I go active or passive, or do I? And then only you would go to a sub-asset allocation to allocate to maybe financials or industrials. And then you think about, how does that fit into my broader asset allocation, or how does that fit into my broader portfolio? Whereas I think if you do it the right way, which in our mind is a top-down way, you would firstly say, what's my need as an investor? What am I saving for? Then you would say, what's the appropriate asset allocation in order for me to achieve my goal? And once you're comfortable with your asset allocation, you go into your sub-asset allocation and you say, am I going to buy the top 40, or am I going to buy financials, industrials, or resources? So am I going to buy like a sub-sector or a sector of a broad index? And then you go into the question saying, do I want active? So am I going to give my money to a fund manager to manage for me, or am I going to go passive? And if you, for instance, make the decision to go passive, you say, I want to go and buy a top 40 ETF. Now let me look at what the top 40 ETFs are out there for me to buy. And then you make a decision, and hopefully in our case, you would say, let me buy the One Invest top 40 ETF. And if you do it in that way, you would, I guess, serve your long-term purpose better than picking from the bottom up. So this for us is very important when you think about holistically your portfolio, or what products or asset classes you hold and how they fit in together. Right, so with that as a bit of a primer, let's think about using ETFs to fill those blocks. So what you've done now is you've constructed an asset allocation. You like the idea of using ETFs. So how do I then plug into ETFs, and why should I plug in ETFs rather than any other product? So let's first look at how you can do it. So the first thing is, you can use ETFs in different ways in your asset allocation. You can either say, I fully want to use ETFs, so let me plug in ETFs into all the buckets that I have created under my asset allocation. And that's the example we're going to go through. So that's creating a full investment portfolio using ETFs. The second one would be to say, let me create a core portfolio using the ETFs. And the core portfolio would be consisting of predominantly an equity ETF, a bond ETF, and possibly a property ETF. And for example, that's going to make up 60 or 70% of your full portfolio. And the other 30% I'm going to use to either buy some shares myself, I'm going to give it to a fund manager to manage for me, or I'm gonna use any other vehicle. So that's when you say ETFs will form the core, and I'm going to play around on the periphery. And then the last one would be to say, I've got a balanced portfolio with the fund manager possibly, but I'm going to use ETFs to supplement that portfolio. So I'm going to use a property ETF because I think my portfolio needs more property exposure, or I'm going to use the money to buy into a niche sector. Like for instance, we've got a global or a US infotech, which is the largest global sector at the moment within a country. So I want to buy some exposure to the likes of Microsoft and Apple. So I'm going to use an ETF to give me that IT exposure. Why do we think ETFs actually serve that purpose quite well? And I guess this is one of the main advantages of ETFs over the last couple of years, is it gives you instant exposure to an underlying asset class. So if you think about it, if you go into OST and you purchase a top 40 ETF, so that's one transaction for you. With that one, exposure to 40 underlying shares. So you get exposure, as we said earlier, to Stanlib, First Rand, Anglo, MTN, Vodacom. So you get exposure to the full underlying basket straight away. So it's possibly the most, the least frictionless process to get access. The second one is it's a great way to diversify. So it links into the first one. So with a basket of ETFs, you can easily diversify a portfolio quite quickly. So if you include a top 40 ETF, a property ETF, a bond ETF, and possibly a global equity ETF, with that, you might only have 4 instruments. So you might only have bought 4 ETFs. But with that, you've got a diversified portfolio of underlying stocks and bonds that will drive the return of your portfolio. The third one is it's very cost effective. And I think cost is always important, and we've all seen the graphs to say if you save 1% over a 20-year period, the compounding effect of that on your portfolio is massive. And I think that's always true. But again, we come back to the times we're finding ourselves in now under COVID, and market distress and turmoil, and the prospects of possibly lower returns for a period of time. Cost becomes very effective, very important, because if you are of the opinion that we're going to see equity markets only growing by, let's say, 5 to 8% over the next 3-4 years, do you want to be paying away 1 to 2% in fees for that, or are you going to use ETFs to deliver you the cost-effective exposure? The fourth one is liquidity. Because ETFs trade just like shares, they are instant. So you can buy, like you're buying Anglos now, you can buy an ETF now. But similarly, if you want to get out of it, you can sell it straight away. So there's no time delay in me redeeming an investment, having to wait 5 days to get my money back. This is selling, like selling a share, you get your money straight away. And then the last thing is transparency. This, over the last 10 years, I would say, have become very important. So if you go back to the global financial crisis in 2008 and 9, since then there's been a big focus on what am I buying? What is my fund manager doing with the money? The investment that I hold, what exposure am I getting for it? And that's where ETFs have got such a large role to play. And that's why I think globally they've been so successful and so attractive, because you know exactly what you are getting. So if you're buying a top 40 ETF, you know the stocks that will be in that top 40 ETF forms part of the top 40 index. Whereas if you use a fund manager and he's got a benchmark of the top 40, it doesn't necessarily mean that he will hold the top 40. He might hold other shares, he might not hold all the shares in the top 40. So the transparency in what I get is less. And then just generally the transparency around how do I get in and out, what are the fees? There's normally no hidden fees in ETF. So it just becomes quite a neat vehicle for you to gain exposure. So right, so now we've dealt with asset allocation, we dealt with why we think ETFs are a great vehicle. And before we jump into the sample portfolios that I'm going to show you, I just want to say that the portfolios are really samples. We recommend that as an investor, you construct your own, or you seek advice from a financial advisor to help you build your portfolio that actually fits your need. So the next two examples should be seen as that. So let's look at a growth balance fund. As we said earlier, you're going to have a goal, and your goal, let's say you are 30 years old and you are saving for retirement and you want to retire at 60, it means you've got a 30-year saving. So you can have a high growth balance portfolio. So let's do the asset allocation first. So we use the 4 asset classes that we spoke about earlier. You can see, given that it's a growth balance fund, it's got a high allocation to growth assets. So growth assets would be equity and property, and it's got quite a low allocation to fixed income or cash. So there's only 20% in fixed income cash, and there's 80% in growth assets. And you can see equity dominates at 65%. All right. So now we've created our asset allocation. But as a South African investor, it's always important to think about how much money am I going to invest in South African market, and how much money am I going to invest in the offshore market. And for different people, that ratio or that percentage is different. What we did in our example is we used 30% offshore, and the reason for using 30% offshore, most collective investment schemes or unit trusts or Reg 28 portfolios normally have a limit of around 30% that you can take offshore. So that's why we use 30. But I think everybody's preference might differ. So let's look at it. So you can see you're sitting with 45% in local equity, and you are sitting with 20% in offshore equity. So what would be suitable to plug that gap? So in the local equity space, you can use the One Invest Top 40 ETF, and in the offshore space, you can use the MSCI World ETF. So with 2 instruments, so you bought one Top 40 ETF, you bought one MSCI World ETF, those 2 can serve as 65% of your full asset allocation. And you shouldn't think of it as two instruments, because in reality, if we look at the top 40 ETF, you can see on this sector allocation, you can see you've got exposure to basic materials, technologies, financial, consumer goods. And on the holding side, yes, Naspers dominates that picture, but still, you've got 40 shares in your basket. If you look at those names, they are across different sectors. Naspers is within tech, BHP within commodities, Richemont is a global consumer good. So with holding two instruments, you get instant exposure. And the MSCI World is even more. So you buy one instrument and you get 63% exposure to the US, some exposure to Japan, UK, the Eurozone, and some other developed countries. Plus, on the stock side, MSCI World, the index, have got around 1,600 constituents. So with one instrument, 1,600 stocks you get exposure to. And these are all, you can see they're all in different sectors, but essentially they're all consumer brands to us, because we use Microsoft every day, Apple, we use Facebook, Google, Johnson & Johnson, Nestle. So all of these are household names that you get exposure to. So with only two products, you can fill quite a big gap in your portfolio. So that is if you look at a growth portfolio. So let's look at an example of a slightly more defensive portfolio. So this would be either you are close to retirement and you've got a high reliance on capital preservation, or if you've got a short-term goal. So I want to save in 3 years' time for my kid to go to university, so I don't have the luxury of possibly losing a lot of money. So you need to be slightly more defensive. So let's look at what this would look like. So again, we start off with our 4 asset classes, and you can see equity and property has gone from being 80% exposure of your portfolio to only being 40%. So you have dialed down the risk slightly, and you've increased your focus on capital preservation. So you've increased your cash component, and you've increased your fixed income or your bond component. So the whole portfolio from an asset allocation point of view is more defensively positioned. Again, let's overlay that with our local and foreign split. And as we said earlier, we're going to have a 30% offshore. And you can see the components that now become big is your local fixed income component and your offshore fixed income component. And for that, again, you can use an ETF. So locally, we've got a One Invest SA bond ETF. So that ETF tracks an index or basket of South African government bonds that are in the market at the moment. And similarly, in the global front, we've got a global government bond index ETF, and that tracks the G7, which are the biggest economies in the world. So they track the issuance or the bonds of those 7 countries. So this is just an example of how you think about asset allocation, offshore local split, and then after you've done that, how do you think about slotting in different products into those buckets? The next thing I want to show you just before we finish up and go to the questions would be our product range. So if you look at the One Invest ETF product range, you can see we've got firstly a simple range or local range, and they've got products in the equity, property, bond or fixed income component. Similarly, we've got a global range, and again, it's got products in the equity, property, fixed income side. And then at the bottom, you would see we've got a commodity range as well. And that's why I said earlier, in the traditional, let's call it the simple way of asset allocation or traditional way, commodities wouldn't necessarily be in there. But as asset allocation progresses, and as you progress in how you think about it, we definitely think there's a place for commodities in your asset allocation. We're going to come back later on online share trading in a month or two, and we're going to talk about slightly more niche or alternative ways of getting exposure or bringing exposure or return into your portfolio. And then we'll touch on things like using commodities in a balanced fund, using something like our Infotech ETF in a balanced fund. But this should give you a full range of ETFs or products to plug any of the asset class gaps you've got in your portfolio. Simon, with that, I'm wrapping up, and we're on the 25-minute mark. The last 2 things I just want to leave you guys with The first one would be to really think about your own circumstances, think about your goal, the risk tolerance, and your current portfolio, and construct it with your goal in mind. And not only in times of turmoil, but always you should revisit your asset allocation, make sure it's still the right one for you. And then second thing I want to leave you with, if you think about a balanced portfolio or long-term portfolio, ETFs is a great way to give you the exposure. It is transparent, it is efficient, it's cost effective, and it's a high quality product. So those are my two parting comments. Simon, are we going to jump over into the Q&A side?
Yeah, we've got some questions coming through, folks. Drop your questions into the Q&A box as and when you have. Wehmeyer, a great question from Fred. He says, do bond ETFs pay dividends or interest? Because, of course, the bond pays interest, but if I'm an ETF holder, am I receiving it as interest, or do I receive it as dividend? Because, of course, there's a tax implication.
Yes, Fred, that's a good question. The thing about an ETF is always seen as a conduit. So it never takes what it receives from either the underlying company or the underlying bond and pays it out as something different. It's just a conduit for whatever that payment is. So for instance, in the equity side, if that company pays a dividend, that dividend comes into the fund and the fund channels that to the investor. So it remains a dividend. Similar with the bonds, if the bond pays a coupon, which, as you rightly pointed out, is seen as income or interest in your hand, that comes via the fund and it gets paid to the investor as a coupon or as interest. So by virtue of using an ETF, you don't change the nature of the payment. It still comes to you in the same way.
Gotcha. Okay, cool. Lorinda is asking, are the ETFs available on OST? Yes, they are. Lorinda, you also mentioned tax-free, and Johan also asked about the commodity ETFs. The commodity ETFs, single commodity ETFs and ETNs are not available in a tax-free account. But all the product here we've been talking about is available in terms of the tax-free account. Craig is asking, are the ETFs designed to generate income only? My traditional view would say that's your bond ETFs, but certainly you could construct an ETF portfolio focusing on income rather than growth.
You can. And as you say, the traditional way of thinking about it would be to say, let me buy a bond ETF. But you can also include some property ETFs, because as we know, property, the dividend yield on property companies are quite attractive. You can think about, there are a couple of smart beta ETFs in South Africa that has got a dividend focus. So they would look at stocks with a high dividend yield. So again, a good income out of that. In South Africa, you've got some money market ETFs as well that tracks STEFI, which is an index. So I think there are a couple of ways where you can combine still having exposure to growth assets like equity and property, but have a bias towards with the equity or property that has got a high dividend yield, which will serve as some income.
Gotcha. Johan's also asking, can you buy the retail savings bond on OST? Johan, no, that is, you've got to do it direct from their website or maximum fund from the post office. In other words, way back in time. Nick, you're asking how to find the ETF funds on OST. I'm going to come back to that because I need to log on because I can't remember the menu name. Chris is asking about ETF volumes. In essence, I mean, he's talking about the ETF GLD. He says only 61,000 Rand traded so far today. The point is that there's a market maker in there, so the liquidity is available even if the market isn't necessarily taking it up. And that market maker also means I'm trading just at or above the fair value of the ETF.
That's 100% right, Simon. If you think about ETFs, they derive their value from something else. So if you say GLD, so the gold ETF, the gold ETF value gets derived from the gold price. And the volume within the GLD ETF shouldn't be seen as the liquidity per se, because the liquidity or how much I can buy of it depends on how much you can buy in the actual gold market. So if you are looking at that number, it should not be an indication of how much I can buy or how liquid it is. You should look at what's going on in the gold market. And similarly, I would say for something, again, like the top 40, you shouldn't look at a top 40 ETFs traded volume to see how liquid it is. You should look at the 40 stocks that underlines that index to see what liquidity is like. And as you said, Simon, the market maker's role is there to provide liquidity. So if you want to buy, the market maker would sell to you, and he would go into the underlying market and go and buy the basket of shares.
Yeah. Nick, I got your answer for you. If you log into the OST platform, the top menu item called Instruments, as you scroll down, you'll see the exchange traded funds and exchange traded notes. That then lists all of those that are available. Johan also asking if ETFs are highly geared like CFDs. Johan, no. In the South African example, ETFs are ungeared. In other words, there's just shares in there. The US does have some geared ETFs, but we don't have that at all in South Africa. Wehmeyer, the two requests, if you can go back to the slide that shows the constituents of the top 40 ETF. Greg and Fred are both wanting to have a look at that slide again.
Perfect. While I'm getting there, this is available on our fact sheets as well. So if you want to have a look afterwards, just go to our website and look at the fact sheets. But there's the top 10.
And I've just
this
dropped,
was as of
end of March. I've just dropped the website link into the chat. It's oneinvest.co.za. Question coming through: what underlies the commodity ETFs? And it's commodity ETFs. We'll come to ETNs in a second. Wehmeyer, I mean, the point is, if you've got a gold or whatever commodity ETF, they're physically going to hold that commodity in storage.
For sure, and not even in South Africa. So our gold is stored in London with a custodian in a vault. So it's not, we're not buying gold futures or gold forwards or some other derivative. As you say, we physically take the money and go and buy the bars of gold and take it to a vault and store it there.
Yeah. And then David is asking difference between an ETF and an ETN, and that distinction is the ETF would physically hold those gold bars. The ETN would not necessarily. They would use different futures. And the question he's asking about is Johan's West Texas Intermediate SBA oil that is trading in the futures. So an ETN might be a futures product. ETF physically holds those shares, those commodities, whatever the case may be.
And if I just add to that, if I normally think about the difference between ETF and ETN, an ETN is normally issued by a bank. So somebody like Stanlib Bank would issue an ETN. So what they basically do is they say, I promise you, I'll give you the payoff of the gold price or the platinum price. Whereas the ETF is a separate fund that physically goes and buys it, and that gold sits, if we think holistically, within that fund.
Yeah.
So as a holder of the ETF, you've got a right to a portion of the gold that sits within the fund. So normally people talk about insolvency or the risk of something going bankrupt. In the fund is not linked to any institution. It has appointed somebody like OneInvest or Stanlib Bank to manage that. But if anything were to happen to Stanlib Bank or OneInvest, that fund will still be safe.
Yeah, that's a great point. Mike is asking a question which is perhaps one of those really hard ones, or maybe there's a simple answer to. He says, what's the difference between a balanced portfolio and a diverse portfolio? Are the words interchangeable, or do they have distinct and different meanings?
Simon, I think they can be used interchangeably. I think balance as a term over the years have been used within, let's call it the unit trust space. So you would see a lot of balanced funds there, and they normally either aggressive balance, conservative balance, cautious balance. So it's a reference to a full portfolio. You can refer to a balanced portfolio as a diversified portfolio as well. But I also think diversified applies to the asset class itself. And why I'm saying that is if you think about, you've got two options. You can go and buy the top 40 ETF, or you probably have more options, but let's say you've got two. You can buy the top 40 ETF, or you can go and pick the stocks yourself. So you can go and pick a basket of stocks. And you might, if you think you hold 6 stocks, you've got a diversified equity portfolio. But the reality is you don't. So I think diversified is more than just thinking about balance. It should also be thought of within the asset class. Is my equity exposure diversified?
Gotcha. Yep. And then a last question coming in from Fred. He says, is fixed income and bonds the same? My sense is bonds could be part of fixed income, but fixed income would be broader than just bonds.
Yes, you're right. Fixed income is normally overarching word that is used for bonds, corporate bonds. Within the bond market, you've got things like convertibles, you've got the bank issuing paper, and they normally refer to it as NCDs. You've got other money market instruments. So that would all normally fall under the fixed income banner, whereas bonds would purely refer to either bonds issued by the government or bonds issued by corporates.
Yeah. And then a great final point from Mike Adams. He says, as an individual, we must look at our entire asset allocation, discretionary and non-discretionary. Mike, I agree, particularly because many of us will have some sort of retirement product, a retirement annuity, a pension or a provident. And in an ideal world, we should pull that into the equation for the discretionary part of our portfolio, as we were talking about this morning. I agree with that 100%. And it's become easier. Back in the day, it was hard to get information out of many of our products, retirement products. These days, we absolutely can. David, yes, ETN or an ETF are both available to trade on the Standard Bank online share trading platform, and the ETFs available within the tax-free as well. Ladies and gents, the questions have dried up, so we will park it there. My thanks to all of you for attending this Friday morning. My thanks to Wehmeyer Ferreira for helping us with the presentation today and talking us through putting together those portfolios and using ETFs to plug into them. The video will be on YouTube in a couple of hours, and I'll be back with Dineo on Monday morning, 10:30, looking at the week that was and the week that will be in stock markets. Everyone, thanks all. Have a great weekend further.